In the United Kingdom, the tax landscape for businesses and the self-employed is evolving rapidly. As of September 17, 2025, Revenue and Customs, commonly known as HMRC, has ushered in a new era of compliance and oversight using advanced legal powers and state-of-the-art data analytics tools. These changes are reshaping how taxes are administered, how audits are triggered, and even how tax bills are issued, all of which can have significant impacts on businesses and creators across the country. Let's begin by exploring HMRC's enhanced legal authority. Under Schedule 36 of the Finance Act 2008, HMRC has the power to request any documents and information that are reasonably necessary to verify your tax position. This applies to all major taxes, ranging from VAT and PAYE to income tax and corporation tax. What does this mean in practice? If HMRC identifies a risk, or even just a discrepancy in your reported figures, they may ask for extensive records, including accounting ledgers, bank statements, invoices, and detailed VAT and PAYE registers. However, before they issue an official information notice, they are required to give you a reasonable opportunity to provide the documents voluntarily. In certain cases, especially if there's resistance or sensitivity, HMRC must seek permission from the first-tier tribunal, ensuring a layer of judicial oversight. This framework is designed not only to empower HMRC to root out fraud and error, but also to maintain fairness and transparency in how investigations are launched. Still, the reach and scope of these powers mean that businesses must be diligent in maintaining accurate, up-to-date records. Failure to do so, or delays in providing requested information, can escalate matters quickly, sometimes resulting in penalties or even formal assessments issued without your direct input. Another major development is the introduction and expansion of the simple assessment system. Traditionally, most taxpayers have been required to complete a self-assessment tax return annually. However, if HMRC already holds sufficient data, such as from PAYE records, P800 reconciliations, or pension information, they can now issue a PA302 tax calculation on their own initiative. This is particularly relevant where tax due exceeds £3,000 or where there are multiple sources of income that HMRC can cross-reference. The taxpayer is then notified of the amount owed and given 60 days to contest the assessment, followed by a 30-day window to appeal if the decision doesn't go their way. For businesses and self-employed individuals, this means that HMRC can, in effect, bypass the traditional tax return process in some cases. The system is designed to streamline administration and reduce the burden on taxpayers, but it also means you may receive a tax bill without having actively submitted your own figures. While this can be convenient for those with simple, transparent financial affairs, it raises the stakes for anyone whose income or business activities are more complex. If the information HMRC holds is incomplete or inaccurate, the resulting assessment may not reflect your true position, making it critical to review any PA302 calculation carefully and take prompt action if necessary. The third pillar of HMRC's new approach is the collection and analysis of data from digital platforms, as mandated under the DACA 7 reporting requirements. Effective January 1st, 2024, online marketplaces, app platforms, and other digital intermediaries are required to collect and transmit detailed information about their sellers to HMRC. The first reporting deadline was January 31st, 2025, covering all income earned by sellers during the previous year. Platforms must report seller identification details, total income, and transaction-level data, and they are also required to provide a copy of this information to the sellers themselves. This marks a significant step forward in transparency and accountability, particularly for creators and entrepreneurs who derive income from platforms such as YouTube, eBay, Etsy, or app stores. No longer can such income go unreported or underdeclared. HMRC now has direct access to granular data about sales, commissions, and payments, making it far easier to detect discrepancies between reported income and actual earnings. If your tax return doesn't match the platform data, or if you fail to submit a return altogether, HMRC can issue an office assessment, a calculated tax bill based on the information they have. This can be both a safeguard against evasion and a potential pitfall for businesses that aren't meticulous in their record keeping. Central to all of these changes is HMRC's embrace of sophisticated data analytics, most notably the Connect system. Connect is a powerful tool that allows HMRC to cross-reference data from public sources, third-party providers, and the reporting platforms themselves. The system looks for anomalies between declared income and indicators of spending or lifestyle, such as property purchases, car ownership, travel patterns, and more. In 2025, the National Audit Office confirmed the widespread and effective use of these analytics, particularly in preventing errors and catching fraudulent activity. For businesses, creators, and the self-employed, this means that HMRC can build a detailed picture of your financial affairs without relying solely on what you report. The implications are clear. Transparency, consistency, and timely record keeping are more important than ever. If you receive a letter or request for information from HMRC, prompt and thorough responses can help resolve issues before they escalate. Reconciling collections, bank statements, and VAT records should become routine practice, as should retaining proof of payments received from platforms and marketplaces. If you discover a past error, voluntary disclosure is often the best route. HMRC's own manuals encourage it, and it can mitigate penalties or further investigation. But beyond regulatory compliance, there's a broader message for both HMRC and the business community. Building value requires trust, transparency, and reasonable time. The new powers and reporting requirements are designed to protect the tax base and ensure fairness, but they must be balanced with respect for those who are trying to build something new, whether a startup, a creative venture, or a growing marketplace business. The ability to collect, report, and reconcile data efficiently benefits everyone, but only if businesses are given the time and space to grow, innovate, and adapt. If the regulatory environment becomes too burdensome or adversarial, it risks stifling entrepreneurship and ultimately reducing the very revenues it seeks to protect. In summary, the updated HMRC rules as of September 17, 2025, represent a fundamental shift in how taxes are assessed, how audits are triggered, and how information is collected. The powers under Schedule 36, the expansion of simple assessment, and the integration of DAC 7 platform reporting all point to a more data-driven, proactive approach. For businesses and creators, this means heightened scrutiny, but also new opportunities for efficiency and transparency. The key is preparation. Maintain robust records, understand how your data is reported, and respond promptly to HMRC communications. This is not just about avoiding penalties, it's about building a business with confidence, supported by a tax system that values growth, innovation, and fairness. By focusing on transparency, reasonable timeframes, and mutual trust, the UK can continue to foster an environment where businesses thrive, revenues grow, and compliance is achieved not through fear, but through partnership.